As Jan Brady would say, Russia, Russia, Russia. That's what was driving markets on Friday and bonds. We'll talk about what that means for you and your money today on 3 Minutes on Markets and Money. On Friday, we saw markets sell off here as Russia headlines really started to ramp up. Concerns over an invasion by Russia into the Ukraine. The reality is there will be a way forward. In fact, Lavrov this morning already talking about a way to get talks started between Russia and the U.S. Look, Russia doesn't want to invade the Ukraine. They don't want the Ukraine to be part of NATO. Ukraine needs to be part of EU for a trading partner. It is all in the best interest of both the U.S. and Russia and the EU to come to some resolution over the Ukraine to get this situation resolved. In the meantime, though, it did put pressure on markets. Here's the important thing, though. Markets had already gotten oversold here back in January, and we talked about a reflexive rally back towards the 50-day moving average, which is exactly what happened. Now, this is the way technicals work, right? You get these oversold rallies that become overbought. That's where we got to on that rally. Then you need some type of headline event to trigger the selling that allows for that retest of the recent lows. We got that with the Russian headlines. Markets begin to sell off here. Now, markets are going to try to flop around here in a bit, but importantly, we're going to see the markets try to hold this January low as support. This is going to be a good area for the markets to build support off of if we're going to get another rally heading into the Fed meeting coming up in March. Is that going to be the case? We'll see here, but any retest of this support that holds is going to set the markets up for a fairly decent rally once you start to see less inflationary pressures. As we get into February and March, it's likely we're going to see a reduction in some of those inflationary numbers. This is going to ease the pressure on the Fed about being more aggressive. If that is the case, you're going to see the market try to rally back up here. There's a lot of things heading forward as we get to the rest of this year. Look, valuations are still high. Economic growth is going to slow down. The Fed is going to hike rates, tighten monetary policy. That's going to extract some of the liquidity from the markets. We're going to see some deflationary pressures as we start seeing slower economic growth later this year. That's going to start to compress earnings, and higher rates of inflation already starting to eat into profit margins. So there's lots of reasons to suspect that we may have already seen the highs for this year for the markets. Maybe, maybe not, but we could see a year where we have a lot more volatility, lots of up and downs, but really don't make a lot of progress this year. Now, there's certainly catalysts that could lead to a bigger decline in the markets, but we don't have those environments just yet. And that's something you shouldn't try to predict for, because that could leave you on the wrong side of the markets. If for some reason inflation falls sharply, all of a sudden the Fed starts to backtrack, does more QE, this market's going to start to advance again. Trying to make a one-sided bet in the markets can often leave you off sides. It's better simply to pay attention to what's happening here, manage that risk accordingly. Right now, we have good support here at January lows. A break of those lows is going to certainly suggest more downside. We need to be more defensive if we get into this lower area of the markets. But until that happens, it's not a good idea to bet heavily on a crash, because it could leave you on the wrong side of the trade. I'm your host, Lance Roberts, for 3 Minutes on Markets and Money. See you again tomorrow.